All right, guys, we are back today with another book report, book review. So, again, the purpose of this is for me to make your trading journey as easy as possible. That way, I can help you get more education, you can get more knowledge, you can get more gems, you can get into trading faster and better and have a better mentality so you can keep more of the money that you make and you can enjoy more of it and you can move ahead faster, get that education that maybe you weren't able to get in other places or other locations. Look at me as your cliff notes. I'm going to do the reading. I'm going to read the books anyways. So I'm going to be able to help you move faster in your trading journey. So today's book is How I Trade and Invest in Stocks and Bonds by Richard D. Wyckoff. So I just finished reading this one maybe like 10 minutes ago. I really enjoyed it because this guy, Henry Wyckoff, he actually had he started the Wall Street Journal. I believe he started a magazine on Wall Street, rather. And so there are a lot of gems. Yep. He got a quote: "We succeed in proportion to the amount of energy and enterprise we use in going after results. Being some methods evolved and adopted during my 33 years experience in Wall Street. Editor, the magazine of Wall Street." So he had a magazine. He sold subscriptions to his subscribers in the magazine so that they could get tips and ideas on how to trade and then move on from there to do better and deeper investigations and research into this enterprise. He talks about it like it's a business. It's something to be taken seriously. But you can do it anywhere in the world, even in, I think he wrote this book like 1790, 1800 something. You can still have traded stocks anywhere in the world like you can today. So let's see. That's a beautiful thing about this. It's just apply yourself and study. It talks about if a man is better suited for the business, it inheres in him by law of nature that he has a right to the whole of himself legitimately applied. So see some first lessons. Oh yeah, this was in 1888 when he first started working on Wall Street. Yeah, 1888. He was making $20 a month. $20 a month. Amazing where we've come from. He would read financial papers at night, study future values for securities when he didn't have enough money to buy. So he talks a lot about here. You don't need money to actually get into this. You need to just simply study. And then when you do have money, you make your selections the same. So he did a lot of paper trading. It says here, I think he did paper trading for about 8 years. And then it took him like another 6 years to get into trading beyond investing. Let's see here. Study and practice are the two things furthest removed from the minds of the majority. Everyone knows that people who engage in speculation for the first time do not want to bother with such details. Most people who are trading on Wall Street are speculating. Most men ask that he be told something good. This is not speculation, it is gambling. For speculation, to quote Thomas F. Woodlock, involves the use of intelligent foresight. Most people use neither foresight nor intelligence. Let's see. He's a market value investor. He looks at the intrinsic value of stocks and future possibilities pointed upwards, so we can do the same. There are other factors to consider, principally 3: manipulation, technical conditions, and trend of the market. Investigation proves that many of those were thus able to affect prices and often made the same mistakes as small traders, only their errors ran into big money in regards to larger operators within the stock market. That is to say that the larger operators in the stock market, people with more money, are making the same mistakes as people who have smaller amounts of money. Yeah. Instead of operating to make money, operate to realize profits so that you have more money to invest. It's best to know your temperament, your personality. If you can stomach or if you can make money trading, do so. If you cannot, take risks in other less volatile investments like stocks and bonds, mortgages, things of that nature. It's important that you cut your losses short. Never give an order unless it is accompanied by a 2-point stop. His recommendation, a 2-point stop. So he makes that distinction in regards to putting a 2-point stop. Most people do not trade with a stop loss. So he talks about different market movements being 30 to 60 days is swing trading, trades occurring across several days, and then also trades occurring across several years. Those are the 3 different groupings. There are many points. He makes many points in favor of the slowly build up process, slowly building up. The most successful class of our clients, his clients, were the far-sighted investors who held or were often able to pick up stocks out of receivership. When a company has been reorganized and assessed, those stocks multiplied many times in value and furnished a most striking lesson. So buying out of bankruptcy is a great time to buy stocks held for many years. It's better to not base your judgment on the news, but on a study of the fluctuations. So-called chartists. The market does give evidence of its future course. Manipulation of the market appeared to have one of 3 objectives: making the public buy, sell, or keep out. The manipulators were endeavoring to do the opposite. Yep, 3 distinct market movements going on simultaneously. The long trend extending over a period of years, the 30 to 60-day swings, the small swings running from 1 to several days. Let's see. Excuse me. Getting hiccups. There are 3 definite conclusions of 3 definite trading methods. The majority of those who are buying and selling securities were almost totally ignorant of the business. 2, they are mentally lazy. They showed no desire to increase their knowledge of the subject, but anybody who gave them tips or so-called information held the greatest attraction for them. Also, very little educational literature was obtainable, and even if the trading element had been inclined to devote thought instead of self-preparation. Yeah, it's astonishing to see how men, shrewd, careful, and successful in their own business, would come down to the street and throw caution to the winds when they undertook to deal in stocks or bonds. So that's I would say that's the case for most today. Except we have abundance of information that is useless. His mechanical methods in trading. real money, he finds, was to be made in the important swings running 30 to 60 days on the average, in which accumulation or distribution was clearly marked while the movement was in its preparatory stages. Experience showed that every well-planned and well-executed campaign in the market had 3 stages. First, in the case of an upward movement, the accumulation would appear, and this might run several weeks or months. Next would be the marking up stage, where the stock was forced upward by either bullish news or aggressive buying until it reached a level where distribution could take place. The third stage was that of distribution. Operations for the decline would be the opposite of this cycle. He needed to find out the reason what the large operator did and how he did it, so he could operate in the same way and probably with greater success. He sees the great advantage that lay in operating with the mental attitude of the professional trader instead of the attitude of the unsophisticated outsider. He first tested out his theory that by dealing in fractional lots. Before he was really successful, he had to practically rebuild his own trading character. One of the most greatest difficulties was impatience. At other times, allowing himself to be influenced by other considerations rather than the action of the market. Overcoming these allowed him to begin to reap a real benefit from all the thought and self-training he had put into the work. Apparently, there are turning points in the 10 to 20 point swings in the market. Success in this business, in this line, consists in having greater aggregate profit over the year than the total amount of losses, including commissions, taxes, and interest charges. The public seems to think that once you know how to tap the money reservoir, all you have to do is let it run. No fallacy could be more misleading. People in general hold to the illusion that any man who can make money in the stock market should make it by the million. It is viewed that large traders make spectacular profits at times, but their losses are usually in proportion, and these you never hear of. Those who make millions risk millions. Often all they have on a single operation, and they frequently go broke, a condition which I have never experienced in the stock market simply because I have never allowed myself to get into a vulnerable position. I have withstood several panics without serious losses. Making a whole lot of money all at once is not his trading objective. He uses a comparatively small amount of money in trading, not over 5 or 10% of his loose capital, because he has no desire to spread himself out too thin or operate in such a way that any unexpected event will cripple him. His method is to pull down the profits and invest them in safe income-paying securities, preferably those which have an opportunity to enhance in value. Much greater satisfaction in operating with a small amount of money for various reasons. It makes you more careful, because having set yourself to the task of realizing a large profit on a limited amount of operating capital, you plan your moves shrewdly and do not take risks such as if you would if operating with more money. In the next place, you feel that you are risking very little to make considerable. The satisfaction in turning 5,000 to 10,000, which is greater than turning 25,000 into 30,000. Talks about traders, even people who are great will lose money. A man who is trading in securities should be able, ready, and willing to sell short with this great facility as if buying for a long account. You got to be willing to sell out if it's turning away from the direction you initially judged, just as quickly as you judged to buy into it. Risk should almost invariably be limited. Dealing should be done in the active stocks. That is to say volatility. You should either make a business of trading or else not try to be a trader. You cannot be successful at trading any more than you can be at mining, manufacturing, doctoring, or anything else unless you are trained for it. And by training, I do not mean an occasional dab. Incidentally, unless you are particularly adapted to the business, you had better become an intelligent investor instead of an unintelligent trader. There's an old adage, it is easier to make money than to keep it. Let's see. Things dealing with the railroads, opportunities, different rates of return, 5% or 10%. He talks about this method of averaging down the cost of the shares you buy. Just don't do it to the point where you now have no more capital to buy because you've averaged down from 200 to 50 when the stock wasn't a good buy at 200. You got in too soon. Every year, new opportunities are there to make growing investments. Whatever is little complicated for the average investor is apt to be overlooked and neglected. To get the best results, one should be familiar with the technicalities of many kinds of convertible bonds and the stipulations under which they are issued. His aim is to show his readers directly or between the lines how they may be able to judge for themselves. There are men who will take no, as written by another author, there are men who will take no initiative on their own responsibility, who will undertake nothing without consulting others as to the feasibility of the schemes and plans they have in view. When a man puts more confidence in another than in himself, he is bound to lose all willpower and become a mere dependent, awaiting orders as to the course of action. It is impossible for such a man to get along in the world and make a success of his own life. When opportunity comes along, he is afraid to seize it without asking his neighbor's opinion. Do not fall into that category. He makes a distinction in the story when investigating a mining operation. He invested a certain amount of money, I believe it to be $23,000, and the stock fluctuated up and down. But he made a distinction in his mind that says he's either going to hold on to this stock until it goes bust or until it goes bonanza. And the fluctuation is great up or down, but that's hindsight. And there are many people who are unable to make a living with their foresight. So it's a logical fallacy to believe that he could have made money with hindsight. And it did just that. And let's see here. Choose your company is a good precept for the investor. He employs investigators, lawyers, mining and oil engineers. He sends people to different parts of the country to get the local color and all the angles on a proposition. After employing one engineer, he sometimes sends another to check him up. It might cost a few $1,000s, but when you're putting real money into an enterprise, you cannot be too sure nor investigate too thoroughly. It is 100% better to have an expert opinion than to take your own or some other layman's view. But an engineer may still be fooled by the mind. Never go into a mining enterprise unless you are prepared to lose every cent you put into it. Some mines are highly speculative, some are at or approaching the investment stage. The problem is to get aboard the best of them before they get to a stage where the cream is all off. In other words, you want some of the cream, and in order to get it, you frequently have to go in early and sit in for a long time before the skimming process can be accomplished. Yep. He bought into a mining operation, set out to find what it was about. Did he take that profit when it went up? No, he did not. He did not go into it for that amount of money. People have joshed him about not taking it. For the last 4 years, it moved between 25 and 55. He didn't tell you because when he bought the stock, he resolved that more money was to be made out of the mine than out of the fluctuations, unless someone was lying. And following his usual resolution to be prepared for the loss of whatever he put into any mine, he made up his mind to sit with $23,000 investment in Magma until it either proved to be a fake or a bonanza. It has proved to be a bonanza, and although the stock is today selling for only one half of its high price of $69, he has not only the same opinion of its future as was indicated in 1950, but he has many, many more reasons for believing in the soundness of the enterprise. Wow. Yeah, the company is highly undervalued. And so he bought it for a value investment, and it is that, even though it may not reflect that on Wall Street. Those situations happen, and they happen frequently. In the main, people have less trouble with their patience when they face a large loss. There is one way in which most of this difficulty can be overcome, and that is by carefully assembling the facts when you enter a commitment and continually checking up all along the line for the entire time that you hold it. There is no need for guesswork if one will take the trouble. It is merely a question of how much labor and expense you are willing to go to in order to make your investment successful. We succeed in proportion to the amount of energy and enterprise we use in going after results. Success is not for the man who is willing to sit down and wait for something to fall into his lap. It is poor policy to wait for opportunity to knock at your door. Train your ears so that you can hear opportunity coming down the street long before it reaches your door. When opportunity knocks, try to reach out, grab opportunity by the collar, and yank it in. I like that. John D. Rockefeller, whose fortune of nearly $1 billion represents investments for the greater part in the necessities or near necessities of life. That is huge in this developing world we live in. A lot of these countries need those necessities. Look over the mediums which John D. Rockefeller and others of his family select, and you will find that they are mostly in the necessities of life. Oil, gas, food, or other near necessities such as iron, steel, harvesting machinery, etc. These are branches of endeavor in which there is an already created and continual demand. Human need of fuel, light, eatables, or materials necessary to produce them. It is a good point to bear in mind. It's really great. That's a really great tip. This guy he had a lot of great stuff to say in this book. He lines up his factors for choices of security in the following order. 1, the long trend of the market. 2, nature and tendency of the industry. 3, trend of the selected company's affairs toward improvement or contrary. 4, character and reputation of the management. 5, financial position and earning power. 6, position in relation to the intermediate, i.e. the 30 to 60-day swings. When all of the above prove up to his satisfaction, he feels safe in making an investment. Of course, there are other considerations, but those are the most important. You have to know if you're in a bear market or a bull market. Markets influence each other, such as if you're in automobiles are influenced by the oil industry. At the beginning, he had to sit down like anybody else and pore over a massive data and statistics and look up records just as a lawyer, doctor, or anyone else has to do when he first begins to practice. But trading and investing is like any other pursuit. The longer you stay at it, the more technique you acquire. And anybody who thinks he knows of a shortcut that will not involve sweat of the brow is sadly mistaken. You make more money not going to Wall Street because you're not distracted by all of the fake news and gossip that occurs. The best studying is done at home. Let's see, yo. This guy got the gems in this one. I'm only halfway through the book. I can't make these videos too long. Man. So he talks about he had invested in trends, the gramophone when the men went off to the army for the war. They got introduced to music. Now they love music, so now they're gonna put gramophones in their home so they can enjoy music. And that was why he bought into the company. So trends, he invested in a trend that he knew had sound justification because it had a market from a cultural experience, a global cultural experience. So in his day and age, Jesse L. Livermore, a man whose stock market operations are the most spectacular in the present generation. Never heard of the man. So just goes to show that make your money and go home. Shit, because fame don't last. Yeah, just like everyone else, he has good and bad periods. It's much like any other line of business. He's yet to find a man in or out of Wall Street who was able to make money in securities continuously and uninterruptedly. Success in trading means an excess of profits over losses. Success in the investment field means more good than bad investments. If anyone tells you he can be almost invariably successful, put him down as trying to impose on your credulity. Let's see this. Frequent investments which turn out badly. Nope. No. Success in either field depends on whether your profits exceed your losses and income. There's a very clever trading rule followed by Jesse Livermore. Unless a stock shows him a profit within 2 or 3 days after he buys or sells it short, he closes the trade on the ground that his judgment was wrong as to the immediate action of the stock, and he cannot afford to be tied up. He says, whenever I find myself hoping that a trade will come out all right, I get out of it. Livermore's purpose in this rule is to keep his trading capital in circulation, never allowing it to become congested. It is a good rule. Think it over, and you will recall that you have often not only lost money by sticking to a hopeless proposition, but you have lost many, many opportunities. It will be observed that Livermore, by the use of these two rules, has both a time and a price stop. He will not devote his margin or capital to a transaction for more than a few days, and he will not let the trade run against him for more than a few points. While he originated, as far as he knows, the first rule, the second, via the use of stop orders, has been one of the first principles of successful operations. Everyone advocates the absolute limitation of risk. So that time stop is great because it means your immediate, your immediate, what is it? Your immediate, what was the word I used? What the immediate action of the stock is. That is what you are trading on. Very often the closeness to the stock markets of Chicago and New York is a handicap. One's real trading is done away from the market, not in a broker's office. The out-of-town investor is therefore not under as much of a handicap as he might suppose. Okay. Video is getting long, but man, these man got the gems, man. Like, I'm gonna be watching these back, so I mean, it's for you guys too, but it's also for me. I'm like, man, this guy got the gems, man. This guy is 33 years. Put it in a book. All I gotta do is read the book. Come on, man. I'm not even 33 years old. He talks about oil, like global demands having an effect on the price values, such as oil, because it's tied into so many other industries. Yeah, many people make mistakes by averaging too soon, averaging down too soon. Everyone should occasionally sit down and take account of stock, not securities, but his own ability, judgment, and what is most important, results thus far obtained. If he finds that the past few months or years have been unsatisfactory and unprofitable, judging from the amount of time, thought, study, and capital employed, he should suspend operations until he ascertains the cause. Then he should set about to cure it. This can be done by study and practice until he is confident that he has overcome the difficulty. It may be that he is a chronic bull and finds himself in a bear market. Yeah, it's a steady accumulation of knowledge, wealth, capital, with the limitation of risk. That's all it is. Yeah, and this is 1888. In an atmosphere of deceptive surface indications, false news, reports, gossip, methods, and such as one encounters on Wall Street, it is sometimes difficult to know just what one is trying to do and how well or how badly he is doing it. It is not easy to size yourself up and to see just what are your basic principles and how well you are following them. And this was in 1888, man. Like, we're in 2023. in 2 decades, and it's still the same situation. Amazing. His primary and ultimate objective is the safe and profitable investment of his funds. He says that because that is his first and principal objective, provision for himself and family during the later years of his life is what every red-blooded man is working for. Most people want to feel that from at least 60 on, they will be free from the necessity of making money on which to live during their declining years. Trading profits should therefore be used to increase the principal sum which is invested in income-bearing securities, preferably those which will grow in market value. Income from such investments should be made to compound itself by reinvesting it as received. If you're not adapted to trading, you should abandon the business. Prove to yourself, to your own satisfaction, and abandon your business. Abandon the business. Man, this video is long, but it's so good though. This stuff right here is taking my trading to a new level. Time stops. It's amazing. The immediate action. That's what gets a lot of people. He does recommend, however, letting your runners run, selling half your position. But I'm assuming that's only after. Well, it would necessitate only being after your immediate judgment was correct. You cannot go into any phase of endeavor and make money or become prominent just like that. You must serve your apprenticeship. Of course, if you want to join the ranks of the large percentage of people who spend their declining years in the care or custody of their children or relatives or in institutions, then you can afford to ignore his suggestion that work and study and long experience are essential. But if you have imagination and can picture yourself as possessing wealth and contentment in your old age, you will immediately admit that it is well worth your while to devote serious attention to this subject. You have to live anyhow, so why not live well? It all depends on you, for you can generally take out in as great a measure as you put in. The man with the wisdom. He doesn't mean read financial columns. He prefers the practical experience of investing in stocks and bonds, making mistakes, finding out why, and profiting thereby in the future. Just like this man he ain't holding nothing back. He's like, I'm going to give you the truth, the whole truth. It's going to be 100% stock of the proof, 100 proof, no, 200 proof of the truth. Just straight put that hair on your chest. Like, man. That's 200 proof of the truth. That's it right there. Oof. A person becomes competent in other fields because he has generally gone through a long period of patience and preparation. In one way, the doctor's work in and out of Wall Street bears resemblance, inasmuch as when he begins to practice his profession, he has to acquire patience. In Wall Street, it is spelled patience. Do you see what he did there? Both are absolutely necessary to his success. Acquire patience. Patience. It's beautiful. He advocates that Wall Street should educate their clients. It's very strange that they don't do this. The brokers. People who stay in the business are in two categories. Those who have outside income and are continually bringing money into the street, and second, those who are successful in their operations and thereby increase their capital, or to a greater or lesser extent maintain themselves out of what they thus realize. A certain amount of mistakes and a percentage of unfortunate investments are to be expected no matter how well you start or how expert you become. But you should always preserve your trading or investment capital by never putting yourself in a position to have this wiped out. It is better to be hurt than killed. If you do not want to be considered one of the public, then you must be trained or an experienced trader or investor, or have to some extent a claim to be an insider, professional, or semi-professional. The sooner you realize your proper position in the financial scale, the more quickly you can adjust yourself. It is stupidity which makes people rush in where angels fear to tread. The young man with his first money might well spend his spare time for 5 years in study, investigation, self-training in order to find out whether he is an investor, a trader, or a speculator. And the more he learns about it, the greater he will realize how very ignorant he was at the beginning. If at the age of 30, he sees the necessity for study, and at 35, he has accumulated some capital, which in the meantime has been reposing in the savings banks or in high-grade bonds or mortgages, he should not even then go in with the idea of cleaning up a fortune, but with intent to cautiously and conservatively proceed so that during the entire balance of his life, he will steadily build up his fund of investment knowledge and capital on a constantly broadening base. This matter is not anything that has to be hustled. You can pursue your regular business with this as a sideline or hobby if you like. You can't learn everything in a minute, but of course, the more time you can devote to it, the more rapidly you can proceed to practice. Preserve your initial capital so that you will never be deprived of it. It is well to learn the methods of other large and successful operators and investors. Imitate them and their methods in a scientific manner. Okay, so let's see. Take the time to go and investigate things, especially if you're putting large sums of money into investments. Go and talk to the management. Get a meeting. Set a meeting up. Go and visit these places if you're going to be making money, because the money that you spend in investigating it is more than worth what you're investing into the actual enterprise, especially if there's a danger of losing there's a risk of losing that capital. Talk to the experts. There are many enterprises that need investigation. Make sure to get your timing right when you are buying on either a rally or when it's a bear market. It is important to know whether large operators, inside interests, a pool, or the public dominate the market for a certain security or group, because that way you know whose hands it is in. A combination of bankers will seldom be found on the long side of the market unless they expect a pronounced change in security market conditions in the near future. This is not the case for the public. The bankers' own purchases, therefore, are an indication of probable betterment. When a pool takes hold, it is usually in a certain one or few issues which are likely to be favorably affected by developments known to a few but not generally known. The same is true of a large individual operator who takes a position with a big line of stocks because he is confident that the future will cause others to take the securities off his hands at higher levels. Operations on such a scale are very often the deciding factors in the trend of the market because of the great quantities of securities which are dealt in. Such purchases exhaust the floating supply and thus lead to a higher level. Large interests and operators also have a way of influencing the market in the desired direction. This we may term manipulation or advertising or marking up or whatever we choose, but it remains a fact nevertheless that this is frequently done. Some people claim that there is a power which dominates the market, and perhaps this is true to a degree, but not in the sense that many believe. Large interests sometimes work together or observe each other's attitude by the action of their respective stocks and thus operate in harmony, but without any actual understanding. There is, however, another group of people operating in the market almost constantly, and this group is really the largest and most powerful of all. He refers to the investment and speculative public, which is in most cases untrained and as a body unorganized. if the public could get together and operate in harmony so that it would not continually be stepping on its own toes, there would be a different kind of Wall Street. For without the public as a buffer, large interest pools and operators would be comparatively powerless. That's huge. There's a huge lesson in that. There's a monumental lesson in that application. Organization of a large group of people. Yeah, that's beautiful. Absolutely beautiful. Absolutely beautiful. The more you learn, the more you realize how little you know, and the more anxious you become to acquire proficiency. Man, so that's the book report. That's the book review. I hope you guys got a lot of gems out of that, because that one took my trading, my understanding, my comprehension, my knowledge of trading the markets itself. It took it to a new level, like noticeably. I noticeably am trading better, especially that one about the time stop, and then the understanding of what manipulation of the market actually means. So it's to say that the institutional investors know something that I don't know. So if they're holding a stock, and I have a choice between institutional investors holding a stock and the public being the majority holder of a stock, I want to lean towards the institutional investors, because they probably know, there's a chance they know something I don't know, as opposed to the public, which generally steps on its toes and is unorganized. Wow. So if you guys got something out of this book, just drop a comment in the section. If you want me to do a book review, just drop that in the section. I hope you guys, using this as cliff notes to improve your trading journey. I mean, as he says in the book, you got to do your own you got to do your own studying. You got to do your own knowledge and application. However, I get a lot of value out of doing this because I like reading anyways, and I'm going to do the reading. So I'm sharing that with you, so you guys can also take part in that. And so, and help your trading journey. And also, this is for me to help my trading journey. So this is something that's great. I got a lot of value out this book. This is one of the books I would recommend this book to other people, just because it has a great explanation of what it means to get started trading, the difference between trading, investing, speculating, where to put your money, how to allocate it, how to do investigations and research and reports, how to take this just as serious, whether you're living on Wall Street or if you're living in the middle of nowhere where no one knows who you are, and you're living in a city where no one knows you. You have just as much opportunity, information, access as the people who you perceive to be in a better position in Wall Street or in the Chicago. They're not smarter or better than you. They're actually more handicapped than you, who are void of the distractions. So that's huge. Like that's erasing those limiting beliefs from somebody who worked on Wall Street for 33 years and saw people lose money and lose fortunes and go broke and bust more than one time on multiple occasions. Wow. So that's amazing. Absolutely amazing. All right, guys. So this was a long one. If you made it to the end, I congratulate you. Go ahead and get a copy of the book, How I Trade and Invest in Stocks and Bonds by Richard D. Wyckoff. And I'll see you on the next one.